Welcome to The Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to The Weekly Option. This is episode 274 on June the 9th, 2023. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Marathon Digital Holdings, Intel Corporation, and GameStop Corporation. And we discuss three new trades on Microvision Inc, SoFi Technologies Inc, and Carnival Cruise Lines. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for The Weekly Option. And for anyone that wants to learn how to trade options, I teach students how to trade options, not just study theory, with the combination of videos and live coaching calls. If you're ready to take your trading to the next level, send me an email to schedule a phone call. Now, the equity markets finished the week less than 0.5% higher. The Dow Jones Industrial Average grew 114 points, closing at 33,876 points. The S&P 500 index gained 16 points, ending the week at 4,298 points. And now it's time for the topic of the week. The topic of the week this week is option pricing. It's always important to understand what changes the price of an option. We're going to go back to the basics a little bit for this one. I received an email from a listener who wanted me to explain my expectation of volatility that would make the trades on the show make money. I'm sure there are other listeners that wonder the same thing. So let's just discuss option pricing today, because it's rare that one person has a question all by themselves. Kudos to the person that sent me an email and asked the question. I know there are other people who will appreciate this. So there are 5 things that can change the price of an option. There are changes in the price of the underlying stock, changes in the volatility level, changes in interest rates, dividends, and the passing of time. And it's important to know what each of these will do to a call or put. For instance, the price of a call option will increase if the underlying price of the stock goes higher, if volatility levels increase, and if interest rates increase. Call option pricing will decrease with an increase in dividends and with the passage of time. Now, most books about trading options are written for professional traders. Traders working for banks and trading firms tend to hedge using stock in order to limit stock price exposure and only to trade volatility. That's what's called delta neutral trading. If you ever see the phrase delta neutral trading, delta is just your option pricing, the risk that is given from changes in stock price. So if it's neutral, it's because you've hedged with stock, and whether the stock goes up or down, if you make money in the option, you're giving it up in the stock. If you lose money in the option on the price movement, you make money in the underlying with the stock. So there is a difference between using options to trade volatility versus creating positions that benefit from stock price movements. I don't focus on volatility trading anymore. The positions that I speak of on the show will be affected by changes in volatility. However, they're meant to benefit from changes in the underlying stock price. This is one of the many concepts that can make options difficult to understand. You don't have to trade volatility in order to make money on options. If you buy a call option and the stock price goes above your break-even price, you're in the profit even if volatility decreases. If you own a call spread that you bought for a discount to its intrinsic value and the stock price finishes above the strikes of your spread, you'll make money even if volatility goes down. So for anyone that's stuck on this point or wants some additional explanation, just shoot me an email and we can definitely discuss, because I don't want you guys to be confused over this. And that's one of the reasons why I hesitate to recommend books on the show anymore, because most of the books, almost all of the books that are written about option trading are written for professional traders who are trading delta neutral. They are trading volatility. I trade stock price. So that's it. Let's go ahead and get into the review of last week's trades. We'll start off with the cover call on Marathon Digital Holdings, symbol M as in Mike, A as in Alpha, R as in Romeo, A as in Alpha. At the time, the stock was trading for $10.03 per share. I looked at buying stock and selling the June 10-half call at 63 cents, which could give us a return of 10.97% in 2 weeks. Well, shares of Marathon Digital fell 65 cents, ending the week at $9.38 per share. The call option we sold lost 46 cents, leaving us with a net loss of 19 cents if we were to close the position. Now, with 1 week left before expiration, I wouldn't make any adjustments. I'll look to let the call option expire worthless and then sell another option against the stock with the July expiration. The July 10 call can be sold right now at 98 cents. Now, you could go ahead and make the trade to immediately be back in profit, meaning you can go ahead and sell that July 10 call and it gets you back into profit and it sets you up for the July trade. We could roll the strike lower in June to try and capture some additional premium as well, but I'm leaning more towards the July option. Of course, you can have both worlds by rolling the strike to the June 10 call, hoping it expires worthless this upcoming Friday, and then follow up by selling the July 10 call at the end of next week so that you can go ahead, or actually a week from Monday, so that you can make money on both rolling the June option lower to a lower strike and make money by selling a July 10 call, assuming that you're going to be left with the stock. So overall, this is sort of like having your cake and eating it too. Just make sure that whatever adjustments you do the math and understand the risk that is inherent. All right, let's get into the credit spread from last week. We looked at Intel Corporation, symbol I as in India, N as in November, T as in Tango, C as in Charlie. At the time, the stock was trading for $31.31 per share. We looked at selling the June 30.5 put spread at 17 cents, which could give us a maximum possible loss of 33 cents per spread. Now, shares of Intel gained 3 cents, ending the week at $31.34 per share. The out-of-the-money put spread we sold is still out of the money. The spread is essentially unchanged in price since last week, and given that we have not approached the break-even price, it really doesn't make sense to make any adjustments on this position. As long as stock expires above $31 per share, this trade is going to expire worthless, allowing us to keep the full premium that we collected for selling the spread to start. Then our final trade from last week was a debit spread on GameStop, symbol G as in Golf, M as in Mike, E as in Echo. At the time, the stock was trading for $24.66 per share. I looked at buying the June 23.5, 24.5 call spread for 61 cents, which could give us a maximum gain of 39 cents, or that would have been a 63.93% return in 2 weeks. Well, shares of GameStop fell $1.99, ending the week at $22.67 per share. The in-the-money call option, or in-the-money call spread that we bought, is now out of the money. With 1 week left before expiration, we're somewhat tied in our next plan. You have the option of flipping the trade from a debit spread to a credit spread by selling the June 23.5 25 call spread at 25 cents. This would allow you to regain some of your loss, but still leave you exposed to a possible additional 50 cents of loss on the trade if stock were to go above $25 per share. That would actually leave you with the 24.5 25 call spread as a credit spread that you would be short. Now, you can pair this with selling a put spread to turn it into an iron condor by selling the June 22-21 put spread at 32 cents. If you did both of those trades, you would approach a full recouping of the full premium that you paid to enter this initial trade. You'll only wear this risk for 1 week. That's the only reason why I like it. It's a 1 week trade, but once again, you need to be very aware of the risk that you'll have on. This is a much riskier trade than simply letting your trade expire out of the money. However, it's one of the best ways to possibly walk away with little to no loss over the next 5 days. It all just depends on your risk tolerance and whether it makes sense to you or not. Trust your gut on this one and do the math. That always is what it comes down to. You've got to know your own risk tolerance and your own pain threshold. And sometimes the fear of losing more money is scarier than simply losing the amount of money that was planned at the beginning of the trade. So stick to your guns on this one and go for it. So that's it for the trade review of last week's trades. All of the new trades for this week's show will use the July 21st expiration for monthly options in the month of July. That being said, let's go ahead and do the cover call. We'll get into this week's trades with the cover call. Looking at Microvision Inc., symbol M as in Mike, V as in Victor, I as in India, S as in Sierra. The stock ended the week at $6.70 per share. I'm looking at buying stock and selling the July 7 call at 98 cents, hoping for a return of 19.10% in 6 weeks. Now you enter this trade by buying stock for $6.70 per share and selling the July 7 call at 98 cents. This trade makes the most money if stock prices finish above $7 per share. The break-even price on this trade is $5.72, and in real terms, the stock purchase will require $670, and you'll collect $98 for selling the option. Next up, we have a credit spread. Looking at SoFi Technologies, symbol S as in Sierra, O as in Oscar, F as in Foxtrot, I as in India. Stock ended the week at $8.18 per share. I'm looking at selling the July 8-7 put spread at 34 cents, which could give us a maximum possible loss of 66 cents per spread. Now you enter this trade by selling the July 8 put at 60 cents and concurrently buying the July 7 put for 26 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $8 per share. The break-even price on this trade is $7.66 per share, and in real terms, you'll collect $34 per spread that you sell and have $66 at risk. Our final trade on the week is going to be a debit spread on Carnival Cruise Lines, symbol C as in Charlie, C as in Charlie, L as in Lima. Stock ended the week at $13.10 per share. I'm looking at buying the July 12.5-13 call spread for 33 cents, which could give us a maximum gain of 17 cents, or that's a 51.52% return in 6 weeks. Now you enter this trade by buying the July 12.5 call for 96 cents and concurrently selling the July 13 call at 63 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $13 per share. The break-even price on this trade is $12.83 per share, and in real terms, you'll pay $33 to enter the spread, and your maximum gain is $17 per spread. So that's it for this week's show. Thank you guys so much for listening. Thank you for writing in, asking questions. I promise you, if you have a question on something that's said on the show, you are not the only one that has that question. So shoot me an email. Let me know what the question is, and I'll clear it up for you, and it might even make it onto the show. So hope you guys have a fantastic weekend. As always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.